Hello. In today's video, I'm going to show you how to invest your money in just a few simple steps. Everybody wants to know how to turn their little bit of savings into big bucks. It's pretty straightforward, and I'll show you everything in under 5 minutes. The best part is that you don't need a lot of money to start, so let's get started. How to evaluate bond funds. Would you like to invest in a bond fund but are unsure how to analyze it? There's a lot of good information available from a variety of services, but how do you use it? This guide explains what information is important and how to use it to evaluate a bond fund. As with many other types of investments, you'll want to consider the bond fund's risk, return, and costs, expenses. Bond funds can have several different types of risk. These include interest rate risks, credit risks, and foreign exchange risks. Bond funds are almost universally very sensitive to changes in interest rates. When interest rates rise, the value of bonds decreases. This decrease hurts the return of the bond fund. Duration. Bond funds are rated by their sensitivity to changes in interest rates by a term referred to as duration. For example, a bond fund with a duration value of 3.5 means that if interest rates rise 1%, it would cause a 3.5% drop in the bond fund. This is a simplified explanation, but more than adequate to use the number effectively. Weighted average maturity is also a measure of a bond fund's sensitivity to interest rates. It's the weighted average time, in years, to the maturity of the bonds in the fund. The greater this value, the more sensitive to interest rate changes the fund will be. Just like individual bonds, bond funds are rated on their credit risk. Most of the rating agencies start with AAA, the highest rating, and move down to a rating of C or D. Typically, anything less than a rating of BBB or BAA is considered not investment grade. Bonds with a lower credit rating than BBB are considered to be junk bonds and are highly speculative. Bond funds rated at BBB or BAA or higher are considered investment grade. Bond funds rated at BBB or BAA or higher are considered investment grade. Require more expertise and are more likely to default and not make their interest payments. Bond funds with lower credit ratings should pay more, but with greater volatility. This means that the interest payments should be higher, if the payments are made. It also means that there is a greater chance the payments will not be made. Foreign exchange risks. Some bond funds invest in foreign bonds with foreign currency. Currencies can be much more volatile than bonds, so this can be a significant risk. Funds can and do frequently hedge against the volatility by various investment vehicles that cover much of the potential loss if a country's currency fluctuates in value. Now that you know some of the factors that contribute to a fund's risks, let's look at returns. After all, you want to have an idea of how much money you can expect to receive. Consider these important facts in evaluating your potential return from a fund. The return of a bond fund cannot be viewed historically. While the history of a stock fund can provide some valuable information, it's just not that helpful with bond funds. Bond fund returns are very dependent on interest rates, which are forever fluctuating. The fund's yield to maturity, YTM, gives the fund's projected yield over the given fund's weighted average maturity, WAM. Remember that the better the expected return, the more volatility you may experience. Before investing in a bond fund, it's also important to consider the costs associated with the fund as well. Costs play a huge factor in bond funds. Besides your price for a share of the fund, look into these fees as well to determine your real cost. Costs can have a significant impact on the relative performance of the fund. Bond funds that are actively managed have an average expense ratio of about 1.1%. Consider that over the same time, the average return was about 4.6%. That means the expenses eat up approximately 25% of the return. Passively managed funds do much better here. The typical expense ratio is 0.2%. Though passively managed funds might not return as well in the absolute sense, consider that many of them actually do return better after subtracting the management fees. Ensure you know all of the costs and fees. Some funds also charge front-end or back-end loads which can really destroy your returns. Investing in bond funds doesn't have to be complicated. The above factors are sufficient to make wise investment decisions. It's not different from any other investment. Consider your expected returns and your risk over a given period of time. The more you're able to maximize your returns while minimizing your risk exposure, the more successful you'll be over time. While with individual bonds, you can look at the exact maturity date, you don't have that luxury with bond funds. However, the yield to maturity and the weighted average maturity provide similar information. You can do a great job investing in bond funds with the above. Thanks for watching. Please like the video and subscribe to the channel.